Fantastic. Good evening, everyone. My name's Kevin Beales. I'm the CEO and founder of Refract, and delighted to be here to talk about growth. I'm particularly going to be talking about growth from a sales perspective and from particularly an enterprise sales perspective, which is where I've had most of my career. I'm going to take you through 10 tips for enterprise SaaS growth. And I guess just before that, I'm just going to take you through my personal journey and a couple of the growth stories that I've been involved in myself, which is I can hopefully share. So I've been in SaaS for almost 15 years now. Started working with a company called MPP, where I was their very first employee. They're now just over 100 people in Manchester and New York now. They provide payment solutions for digital content. I then joined another tech startup company called Communicator, who do email marketing. I'll take you through their growth story in a second. Before founding my first SaaS business, the Test Factory, back in 2008, and we provided online tests and exams. And again, I'll just take you through that growth story. And then after exiting the Test Factory, we spun out a company called Technically Compatible, and myself and my colleague sat just by the post, Richard, founded Refract last year. Since that exit, it's also just given me an opportunity to be involved as an investor in a number of SaaS-based businesses, which just to briefly mention, Altitude Angel is an air traffic control system for drones. Technically Compatible does IT recruitment assessments, and you may be familiar with Receptive, who help SaaS companies make data-driven product decisions from the noise from customers and internal teams and make growth-based decisions. So I'm just going to very quickly, before my 10 tips, just take you through two of those growth stories. So the first one I'm going to start with was Communicator, where, as I say, I joined as the fourth employee and headed up their sales team. And this was by far my easiest SaaS journey. This was when it all seemed so easy. The timing was perfect. It was an email marketing platform, and although that was very competitive, there was lots of people with similar technologies, functionality, and features. That was really taking off in the market, and we very quickly, over the period of 2 years, we went from 4 to 50 employees. Built a sales team of 20 and built 3 million in recurring annual revenues. That was very much, though, selling software and a service. So most of our customers that were blue chip customers were cash rich but time poor. So being able to provide them with managed services, data collection, design, but all of those being incorporated into subscription services. And that was sold to Trinity Mirror for an 8-figure sum about 18 months after I left. Just wanted to cover with these two quick stories what I would do differently. I guess what I learned and what I would do differently. And definitely in this instance, I think everyone involved with the business didn't realise just quite how good we had it, and we weren't ambitious enough. We didn't raise any external funds. We made the sin of everyone paid us monthly rather than annually, so that perhaps all of our growth was organic. And although it was a good story and great to be part of, I think everyone that was involved actually has some level of regret that it definitely could have been better. And indeed, some of our competitors did achieve better exits and sold to the likes of eBay and Salesforce and IBM for higher sums and higher multiples. As I say, from there I went to start the Test Factory, providing online tests and exams. To start off with, this was for a corporate audience that would use this for testing of product knowledge or recruitment tests or compliance assessments. And I guess our first real breakthrough was we had the opportunity to start providing custom platforms on top of our SaaS solution, the first of which was for Microsoft for their partner network, providing a certification portal. And this really fueled a period of a high level of growth, but building these custom solutions on top of our platform. We took on VC investment, that further grew the company. We embraced the EdTech sector, started selling to exam boards and education publishers. And as I mentioned, we, I guess, very conscious of the fact that we were building lots of custom solutions on top of our platform and were very uncomfortable with that. We looked for other ways to create more traditional SaaS recurring revenue. So that's why we launched Technically Compatible, to take some of the technology that existed and create a recurring revenue stream with some of the resources and talent that we had internally. We were, as I mentioned, really creating a challenge for ourselves with all these custom solutions. As the business continued to grow, we knew we were taking on a lot of technical and resource debt, and although they were recurring revenue streams, it was inevitable that eventually we would look to pivot and essentially decided to take all the learnings that we had from all the clients we work with and build a more configurable, best-of-class platform. And we did that with VC investment. And at that point in time, we had the decision. We were looking, a lot of our clients were based in the US at that point, so we were looking to embrace and go over to the US, but we had an opportunity of an early exit at that point in time from the largest provider of tests in schools, which ultimately we took. But just very quickly, just to cover what I would do differently as part of that journey, we actually became too comfortable, I think, with our VCs. So we knew we were building up. Unfortunately, I've kind of, having examined it quite, over quite a time, although I take it as a necessary evil that we actually had to build some of the custom solutions on top of our platform to achieve the levels of growth, to unlock some of the investment that we did unlock, and ultimately to achieve our exit. So whilst that was always uncomfortable, I think that was a necessary evil. However, I do wish that we'd pivoted perhaps to build this best-of-breed configurable platform earlier in our journey. We didn't have the support of our VCs to do that earlier. We didn't have the revenues that we could rely on to stop selling and just spend a year building that previously. But I do wish we'd actually seeked funding externally. The other thing that was a definite lesson is we underestimated just how big a bet Technically Compatible would be. It was all done with very good rationale of creating more predictable recurring revenue without the headaches that we had in the test factory. But the resource, the money, the focus that it took up, it became a big bet, and in truth could have made or broke the business. It worked out okay. It wasn't required by our acquirer, and we had the opportunity to spin it out, and that's since gone on and taken on VC funding itself, and is embarking on its own journey. But it was a big bet. So I'm going to take you through quickly rattle through my 10 tips for sales-led growth. So I'm going to start with value-based pricing. So obviously pricing is a provocative subject that you could do a whole session on. But I guess one of the things that you get in enterprise SaaS is that you don't have to anchor yourself to a pricing plan because of targeting a self-serve sector. So because you don't have to necessarily anchor yourself to that, how do you differentiate from people that want exactly the same product with exactly the same features, maybe with exactly the same volume, but have completely different value propositions from what they'll get out of that? So a perfect example of this is at the test factory. We had a small Northeast training company that did more online tests and exams than United Nations, who were using this to decide on, who would go on peacekeeping missions around the globe. Now, obviously, the value proposition was completely different, but the technology they were using the same. The volume was, as I say, larger in the Northeast training company. So some of the ways that we've achieved that is the combining of services into to the subscription. So looking at things like what integrations are required. Do they require 24-hour support? Do they require this to be in escrow for their comfort? And that's the kind of things that perhaps distinguish from big blue chip companies that are going to pay a lot more money and a higher level of subscription. So you're tailoring the subscription amount around the organization rather than anchoring yourself to a rigid pricing plan. The second is not to sweat the competitors. That obviously you want to be aware of competitors, but particularly in enterprise SaaS, you're predominantly selling a solution to a problem. You're not necessarily selling a product, And therefore, when you're positioning that solution, you're hopefully building bridges with a potential prospect that they're not necessarily going to want to go out there and look at who else does this, what features they've got, how much it costs. So you might have that market knowledge of knowing exactly how much your customers may charge, what features they may or may not have. But actually building features or changing your prices because competitors are can be, in my experience, can be very short-sighted. You just don't need to do that. You'll be leaving more money on the table by trying to align yourself to competitors who frankly, you don't necessarily know exactly how they're doing financially in any case. Another tip or lesson was not to worry about over-licensing. So one of the things that has come up in a number of businesses, but particularly in the test factory, was that we would have prospects that wanted unlimited licenses. So people like Microsoft who wanted to provide a public-facing portal couldn't tell us how many people might or might not go through tests or exams, and the discomfort, if you like, internally of providing an unlimited license and what that might mean and the potential repercussions. And I guess there's two reasons why from our experience we became comfortable with that. The first is obviously that a lot of those fears are never realised. People tend to overestimate their usage rather than underestimate. But even if they are realised, and we did have a couple of instances of this, it didn't prove too difficult actually to go back and to renegotiate a contract, either to talk about what might happen at an annual renewal or talk about a contract extension, because ultimately if it is working, it is successful, it becomes very sticky very quickly. Not necessarily talking about changing prices for what's already committed to, but they've got a long-term path, they're committed to your profit and success as well. So it didn't prove too difficult to actually go back to the table, negotiate a longer deal on much better commercial terms. The next tip is to take the deal now. The enemy of closing an enterprise deal is time. Over any period of time in any sales deal, the value is eroding. The chance of change in their priorities, what they're looking for, the organisation, the people that you're working with. Time is the enemy of closing the deal, and particularly in SaaS when revenue is potentially triggering further investment and growth. Taking money now, not necessarily heavily discounting, but looking at ways to try and close that deal as quickly as possible. And if it means taking 80% of the value now to create a compelling event, rather than waiting 3 or 6 months and taking the chance of getting 100%, well, first of all, you've missed out on 3 to 6 months worth of revenue before you talk about that discounter in any case. So we were always looking at ways that we could ensure a compelling event to try and close quickly. One thing that would come up quite a lot is waiting for a financial year. So we would often do things like an 18-month contract where there was no payment until 6 months down the line when the new financial year kicked in, but that was all contractual, and we were comfortable waiting for that money to sign off the deal now, get 18 months worth of revenue committed, even if the cash came somewhere down the line, rather than waiting for financial years. I recently wrote a blog for SaaScribe on embracing the average salesperson, which I think was slightly provocative. But if you're trying to build a SaaS business only with rock stars, only with high performers, that's going to be really hard work. There's not that many of them that exist. So whilst average isn't necessarily what you're aiming for, if you can't build a business that can be successful with average performers, then you're really going to struggle. You're going to have high levels of churn. That in itself is going to inhibit the growth that we all need to achieve to be attractive as SaaS businesses. So you have to have a model where you can be successful. You can aspire to rock stars, you can aspire to higher performers, but you can actually be successful with average performers as long as you can manage out poor performers as easily as possible as well. Looking at creating a strategic prospect list. So the kind of clients, knowing the kind of clients that actually you'd have those clients even if you didn't make any money on them. That it might be someone that you're going to win from a key competitor that you're going to roll out time and time again when talking to one of their clients, or when you're prospecting against one of someone that's looking at both solutions, and you're going to profile them as the example of someone that used to be here and now works with yourself. Someone that might be attractive to investors, someone that might be adding value at exit. For us at the Test Factory, United Nations and Microsoft were basically those clients that really meant no one felt the need to do due diligence before using us. As a blue chip organisation, they felt that that those organisations had already done the levels of due diligence that might be provided, and they had that level of comfort immediately working with us. We also had good success in fishing in the remotest ponds. So looking basically where no one else is looking at the use cases for the technology, looking at the geography. So we were successful, for example, in looking at areas where none of our competitors were based. There wasn't a natural competitor there, and actually going hard on that particular geography, or thinking of the kind of companies that wouldn't be naturally considered, not necessarily the big blue chip high street names, but the kind of organisations that may be a bit less serviced. I guess as a shout out to Receptive, looking at growth-driven product development. So very easy within SaaS to just, you get a lot of voices from customers and internally of what needs to be built. Often the loudest voices in the room win, and you often end up building things maybe for your key clients or your biggest clients, but they're not actually even affecting retention because that customer wasn't going anywhere anyway. They're not necessarily going to pay any more money for it, and although obviously you're continuing to keep them happy, you're not doing anything to promote your growth strategy. So looking at making informed product decisions that are aligned to your strategic growth aims and can unlock money from your existing customers. So one thing at Communicator that I think we were quite good at is looking at what could we do that if we could take another £5,000 off each of our clients for adding this in, looking at those kind of decisions that we knew would be able to unlock large sums of money for relatively little effort. My ninth tip is just looking at a couple of cash flow hacks, some that you may be familiar with. I guess the main one, and the one that obviously is much talked about, is just trying to always ensure it's annual subscription first rather than monthly. So we then again, that's easier with SaaS organisations. That doesn't come up with as much resistance. At the Test Factory, we achieved about 90% of our customers were paying annually as opposed to monthly or quarterly. And again, with enterprise organisations, that's not too difficult. There's a couple of other hacks. I'm sure most of the people in the room are familiar with R&D tax credits, but if you're not, you really need to familiarise yourself with them. A fantastic way for software companies of being able to take on cash rather than a future deferral of corporation tax, that you can use that cash for immediate growth. We had some success, not necessarily what I would aspire to or recommend, but we had some success in a couple of our businesses of when we were going through an investment round, or when there was an investment round forthcoming, we were able to negotiate with HMRC to postpone PAYE payments for 3 or 4 months, particularly if we could show some evidence of what we were achieving as a business and the investment event that we were hoping to embark on, and literally just postpone that payment for 3 or 4 months, which again would help be able to invest that in other areas of growth. And then you've obviously got things like using Market Invoice, using Lighter Capital now, who I've not used myself, but as a way of raising funds for cash flow growth. And my final tip is, especially as a business starts to grow, it's very easy to start to lose focus, and everything becomes important. Some of the detail becomes important. So one of the things that we really drove into the teams is to continue to ask the question: does it move the share price? So in everything you're discussing, that question of and getting everyone to ask the question, does this move the share price, was a great way of very easily focusing on what is really important and not losing sight of the things that feel important on a day-to-day basis. So promised 10 tips. It would be remiss of me not to just quickly mention that one of the best ways for sales-led growth is obviously to invest and improve your sales team, and there are video tagging platforms that can help you give coaching and feedback to sales teams. So for example, online demos and meetings, being able to tag key moments with their comments and then use that as a coaching tool of just skipping between those tag moments to improve improve the performance of sales teams and obviously improve revenue. But thanks very much. Been a pleasure being able to do the talk. Thank you. So this is quite an interesting one because I've got an angel investor that has invested in my businesses. I guess comes under the category of friends, families, and fools. He mocks me for how I am with my investment hat on as against how I am as as an entrepreneur, because obviously you're looking at the table from a completely different perspective. Do I look for different things? I guess I'm comfortable as an investor. Each of the businesses I've invested in are sales-led businesses, so I'm looking for the things that I think can solve some of the challenges and problems that I've been through myself. Which I guess you can break down enterprise sales into it's finding product market fit with a big market, and then an ability to be able to successfully scale that. So I guess that's what I'm been looking for with an investor hat on, but it is a completely different perspective, and I know that I talk and act differently with that different hat on. As I say, I'm kind of mocked for it. Do you want me to take the second one?
Take the next one, yeah.
So are custom solutions the death knell for SaaS companies? So they definitely can be. I mean, I'm probably underestimating just some of the challenges and hard work we went through at the test factory. That story played out over 7 years, and as I say, hopefully it could be considered a successful one, but it was a risky one. I think that the thing that just about saved us at the test factory is we weren't building custom solutions. We were building kind of custom portals on top of our platform. But that itself is not without risk, because you're then you are building on top of foundations that then might become quite difficult to change going forward. Having said that, if it is successful, and it was the thing that allowed us to grow very quickly, and we did. We were going through 300-400% growth year on year at that point in time. That did unlock the investor capital that we wouldn't have otherwise been able to achieve, and that in itself unlocked us being able to get investor capital to build what would have been, if we'd had the chance to launch it, a really best of breed platform that we could have taken with confidence and grown out in the US. Can it be the death knell? Oh yes, definitely. And if the model is custom solutions as opposed to a thin customized layer on top of a platform, then almost certainly it's a death knell. I wouldn't want to ever do it again. I definitely wouldn't want to ever do it again. So I put anyone off. But as I say, I do take it that it was a necessary evil in the business we were in.
Right. Seeing as the third one got a vote, snuck in there, and it's on 2. Go for that one. Make that last one.
What pricing model targeting large enterprise and small businesses using the same solution? So it's as I say, you've got this slight benefit of not having to publicise prices in enterprise SaaS. That that it can be tailored solutions around asking the right questions. But that's where you need to be. You need to be able to justify that as well. You need to be able to convince Microsoft that you haven't just added a 0 onto the end of their contract because they're Microsoft. You need to be able to justify that. So looking for things that you just know, not giving things away that are crucial to an audience that are prepared to pay for them. So I think some of the examples I gave were things like the 24-hour support, putting your solution in escrow. For someone like Microsoft providing a public solution out to their partners, they couldn't afford the risk of that not being in escrow. So given that choice, you were able to align them to that kind of value. I think the other thing as well is it is easier to get annual revenues out of larger enterprise clients. Small business, you may be forced to take on more like monthly and recurring subscriptions. There is a downside to annual subscriptions, which is that it has a renewal point. It has another decision point. The great thing about monthly subscriptions is they just kind of roll. Whereas annual subscriptions, you are kind of there is an event where they choose whether they're going to carry on working with you or not, and that has a fixed date or deadline.